Greetings, everyone. In today's lesson, I will talk to you about uselessness of technical indicators, and this thread I would start to one of the more common indicators, which is called relative strength index. So, little context here. These indicators are traded, or people recommend to trade them, such as oversold, overbought indicators. And what that means is that, for instance, if signal indicates that prices are overbought or oversold, you have to do reverse. Like, for instance, if here we see that prices are an oversold range, you should buy, and if yes, oversold. I think I told oversold. No, that doesn't matter. If prices are oversold, you should buy, and if prices are overbought, you should sell, because after overbought or oversold, action reversion should happen. That's the theory. That's many people propose that as very simple and quite effective ways how to trade markets. But I would say to you that's completely useless, and you should ignore those types of trade. Why? Well, let's find out whether this actually works in real life. Let's take 15. I think 15 would be best amount of trades which we should take. Let's say random 15 trades in sequence and see whether it has some practical significance. And let's see this Dow Jones Industrial 4-hour chart and sort that out. Okay, it's really simple. We would see if those buy and sell signals actually work. So first we have short trend around here, and no, we have a long trend. I'm missing the point. Yes, we have oversold territory here, which implies that we should go long, right? But if we see those prices, we are around here, which means no, this trade would be wrong. Second scenario would be here, roughly here. It's difficult to see where we are here because the prices are very volatile at this point, but no matter, let's say we are here, and okay, we are right. I will give that to them because after that prices rise slightly. Let's be fair. Whether we will calculate these moves, okay, we'll be generous and wouldn't calculate these moves. So here probably wouldn't happen much, but still. Next is clear indicator that trades are above the range, so we have to short. Yes, no, it has no significance after all because markets continue to climb unless you want to hold very long losing position. And second trade is here, roughly here, and it failed only after it risen, and the levels of rise and fall were the same, so I wouldn't count that as a good indicator either. Now we have four. This is like fifth trade here, which is completely wrong because after one rise it continued to fall, and here, okay, let's give that to them. 2 trades out of 6 are roughly correct. Third scenario is here. Now here's the thing, it might just bottom out at the lowest point, but it was not indicator to sell was around here, and after this signal markets continue to fall, so I wouldn't count it as an entry signal either. Same here, you see we should short it around here or here if the indicator told us so, but after that markets fell a while, so 8 trades. Out of 8 trades we have only 2 meaningless signals with very small amount of profits. Okay, same drill here, 9th trend. Okay, let's give it 3 out of 10. This is 10th trade, and here markets kind of bottomed out here, and if you shorted here, maybe you could get something like. Okay, now I have 11th trade. Here markets supposedly have to go short. No, they did correct it slightly, but then they rised up again. And then we have 12 trade. Here the same thing, markets continue to rise after short signal. Okay, let's be generous and doesn't one count this fake entry as another signal. So we have what, 12 I think, let's say 12. 13 trades, same here, we have short trend here, short term trade here, not short term trend, which is completely wrong. 11, 12, 13, 14 is wrong here, so it has like, we have like 14 trades, and I think 2 of them were more or less accurate. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I think we had 14 trades. I might be missing something, but I think I calculated that probably only 2 of them were more or less valid. So what does it say to you? This strategy, for common strategy for trading indicators, is utterly useless, and not only it's worse than random chance, but they are missing key points. Like if someone says you should sell here, like this was the place. No, excuse me. It was oversold and markets told you to buy. Yes, indicators told you to buy. What does it say you? Does it say you how large are stop loss and take profit trades? How large are probable risk rewards in those take loss and stop loss, take profit and stop loss levels? No, it doesn't say you. If someone is short, doesn't mean nothing, because as I say, how much you're risking, how large are your stop loss to take profit ratios, everything that should be have taken into context. And if some indicator says you have to simply short, it's nothing. It doesn't have any relations to long-term trading. And that's why I think you shouldn't overuse these indicators, because actually they have no real purpose. This was just one strategy of one indicator I just show you. And I show you this because it's very popular and average novice traders use them. And I remember myself when I was learning forex 14 years ago, people and brokerage houses told me that yes, this is valid strategy, every novice trader should learn it, but as you see, it's completely useless. And in fact, I think it's even better if you could use it in reverse than in actually as it intended, because when the prices are strong, as you see for instance here, if they are oversold, where I have some good example for oversold prices, I don't know, but my point is that if prices have strong movements, they tend to move strongly. For instance, here you will be better off if you shorted this position than to go long, because markets continue to rise. But obviously this is not a good strategy. Well, as I show you that example just to make a point. This strategy is so bad that you could be better off if you used it in the reverse, not to buy here and sell here, but to buy here and sell here. So you buying over both markets and selling over short markets, because strong moves then continue to move. That's the point. And in this context, without any other information on risk management, risk reward per each trade, and extent of stop it and loss levels, you shouldn't actually be doing anything. That's why ignore these simple strategies which are offering you by people who want to receive quick clickbaits and lure you to some sort of signals which promises you unrealistically high returns with extremely high accuracies. That doesn't work like that. I hope I show you that, and wait till my next video where I will be giving you more similar examples. Bye.